Next, Mark Seymour from Northstar Asset Management. Mark, thank you so much for coming through this morning.
Great, Eugene. Thanks for inviting Northstar. Today I'm going to be discussing two topics. One is political interference, and the other one is comparing the dot-com bubble to what's happening in the AI space today. So two topical points of discussion, and essentially to give you an idea about how Northstar is navigating or navigates the world of uncertainty. Okay, so some wise words of wisdom from successful people that have navigated uncertainty. We've got Warren Buffett. Forecasts tell you a great deal about the forecaster. They tell you nothing about the future. So Warren, I think, here is trying to remind us that it's not about making precise forecasts in terms of numbers and timing, but rather to apply data and analysis and research to better understand what drives markets and what are the main mechanics that drive events in the world. It's a quote that's often attributable to Winston Churchill, but those who cannot remember the past are condemned to repeat it. Now we know this. When we look back in history, we see periods of booms and busts, and essentially it's a function of the kind of cyclical nature that governs the way things unfold, and it's largely as a function of human behavior. And we know that at any point of stress, the prevailing narrative, we arrive at a point where we say this time it's different. And it's a function of making decisions to appease short-term stresses or short-term tailwinds, which inevitably are unsustainable. So, that's a concept which I think comes in really handy when managing money. And then there's Howard Marks. We may never know where we're going, but we better have a good idea about where we are. Equally important, because we can have very fanciful ideas about the returns that we're going to generate, or what's a good company, what's a bad company. But if we don't understand exactly what the current conditions are, what the starting point is, we have very little chance of actually getting to our destination. So, some big concepts about dealing with uncertainty. So getting on to the first one, and that's political interference, comparing the latest Trump presidency and administration versus the Nixon administration. I've got a video clip. I think it's a couple of minutes long.
Gang. This is what they wrote. The consequences of Trump taking over the Fed are hard to predict, but history is not encouraging. In 1970, Richard Nixon, who wanted a rate cut to juice the economy ahead of his 1972 re-election campaign, tapped Arthur Burns, one of his top economic aides, as Fed chair. Under Burns, the Fed delivered. That move is now widely seen as contributing to the double-digit inflation spike that roiled the country during the 70s, only after a new Fed chair came in and raised interest rates enough to trigger a recession.
We have a real terrible head of the Fed. And if he brought down interest, in Europe, the European Union, they've lowered their interest rate now 11 times. And we haven't lowered ours at all. He's a stiff. He's a knucklehead. At a certain point, it didn't matter anymore because the guy is just not a smart person. Shouldn't have been there. I think they extended him because they knew how much I couldn't stand him.
You disagreed over the cost of construction at the Federal Reserve.
It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added
our entire capital.
Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
I think we're underappreciating how fragile things are. The global financial crisis, that was 2008, 2009. I can't tell you how many economists said that could never happen. It happened in the Great Depression, never going to happen again. Winding up to today, that the U.S. can never run into problems with its debt, because that never happens. But it did. It doesn't mean we know what's going to happen looking at history, but I think if you don't look at history, you forget what could happen.
wow, the system is shakier than it looks. I don't know. Am I right about that, sir? Am I wrong about that? What say you?
Okay, so the point is that political interference can potentially have large consequences. If we look back to the early 70s, the same happened with Arthur Burns, the Fed chair at that point in time, where he was strong-armed into lowering interest rates at a point where clearly the system needed stability. And it's largely considered that what set the base for the rampant inflation and the stagflationary environment that ensued. And so what we have now is exactly the same thing happening under Trump, where the Fed has been attacked. Now, it comes back to the point in terms of the booms and busts. I mean, the Fed is by design there to try and ensure that there are no, the short-term political cycles of 4 years, those pressures don't kind of spill over, and you have the Fed is there to actually stabilize. So the bottom line is that, to us, it's a red flag if the Fed has been challenged. That potentially is a risk. Okay, so then turning to the dot-com bubble. Now, we know that during that period in time, there were new technology, new ways of communicating. Obviously with the event of cheaper computers, basically, allowed for easy communication for everyone across the globe. And with that, new business opportunities. And, a very short space of time, the 80s and the 90s, new businesses came into existence with promising ideas. However, a lot of those could not be translated or were not sustainable in terms of the actual business model. So I've got a list of companies there that were very prominent at the time, but simply failed because of a failed business model. So inability to generate sustainable revenues and inability to be able to extract sustainable profits out of those companies. So what I'm saying is that at that point in time, it was a great time to be invested. It was very exciting, but a lot of people lost a lot of money. It was very difficult to be able to choose the winners. But even if you were able to choose the winners, the point is that, did you know what the right price to pay for those businesses were? So I've got some interesting slides here. I've put some data together to give us a broad overview that'll allow us to kind of compare the dot-com bubble to what's happening currently and to see whether the same type of market mania is present or not. Okay, so at that time, during this period, we had Amazon, which we know is one of the success stories. It's grown its earnings 1,800 odd times over this period from the time it started generating earnings. We had Cisco, it grew its earnings by 261 times over the full period. Microsoft, same story, 216 times. Intel, which I consider one of the survivors, but that's open to question. As of late, they've been unable to remain competitive and are potentially under great threat. Qualcomm was another winner, 100 odd times growth in earnings. And then you've got Oracle as well, very successful companies. Now, you can see, just looking at those charts, there's some takeaway points. In the first 10 years, you can see that earnings growth is very rapid. That's understandable. The other thing to note is that those returns were diminishing as time goes by, and that's a function of having to generate profits on a larger and a growing company. The point here is that this chart's in log format, so the slope of the graph kind of gives you the rate of growth. And you can see that in more recent times, the growth rates for a lot of these companies has been a lot lower. Some interesting stories here. Microsoft has been able to reinvent itself along the way, and so it's been one of the more recent winners in terms of being able to generate high growth. And then you've got Amazon as a standout. And then obviously I mentioned Intel, which has now obviously with the story in terms of geopolitics, etc. The US government has taken a 10% stake in that company in an attempt to secure strategic assets for the US and then also for the company itself to potentially survive. It spent a number of years buying back shares to support earnings growth, but failed to innovate sufficiently fast enough to be able to maintain leadership in its space. Okay, so that's the backdrop in terms of earnings, which is a good measure for shareholder returns. I now look at each of those companies and look at the share price performance. Firstly, during those first 8 years leading up to the dot-com bubble, and then subsequently. And that's at the heart of what I'm trying to analyze here. Amazon, in its early days, even before it was showing any earnings, gave you 300 annualized returns in the early days, which is fantastic. Subsequently, it's actually been one of the winners, even if you had bought it at the top of the market. So that's rebracing the price to 1 at the height of the dot-com bubble. Even though you had a 90% drawdown, you still managed to generate an 18-odd% return over the full period. So that was one of the successes. Looking at Cisco, fantastic 80-odd% annualized return over the first 8 years. However, since then, you've actually had no return. So it's one of the companies that has generated steady, decent growth. Yet, if you bought it at the top of the dot-com bubble as a shareholder in terms of price returns, you basically made no money. And then we got Microsoft, 50-odd% annualized returns. One of the success stories there, you still had to, if you bought it at the top of the dot-com bubble, you would have had to wait 10, 50 to get back to where you started. But over the more recent years, you've done quite well. And if you had to bought that at the top of the dot-com bubble, you would have made a sort of, about a 9 or 10% return, which is not bad. Then you had Intel. I mentioned Intel was a stellar returns for shareholders during those first 8 years, 50-odd% annualized return. However, since then, you've just had capital destruction. Qualcomm, same story, 80-odd% annualized returns. Big drawdown, you would have had to wait close to 20-odd years to get back to where you started. And then over more recent times, on very, very attractive valuations, it's actually managed to generate decent returns for shareholders. And then Oracle, have I got that one there? Yeah, same story, very nice returns. However, more muted since the top of the dot-com bubble. So my point here is that, during that phase, it's difficult to even choose companies that would survive. And then equally important, paying the right price was potentially perilous, simply because of that fear and greed element that I was talking about earlier. So the point is, are there any learnings from this exercise in terms of the current AI story? So just looking at the dot-com bubble at the start, EPS growth of 65 for those the first 8 years. And what's quite interesting there is that those companies on average operated on a PE of 40 for most of that time, which is potentially quite reasonable. But the key point here is that in 1998 or 1997, there was a complete dislocation. You went from a 40 PE up to 126 PE. So it was just generally those 2 years that just the market lost its mind, really. Comparing that to current times, you can see that artificial intelligence stocks into 2 buckets. Cloud infrastructure platforms, so the likes of Meta, Adobe, Microsoft, Google, Amazon, and Oracle. We can see that EPS growth has been great, 30% per annum, which is spectacular. Yet the share price has lagged somewhat. So there's no sign of that market euphoria that took place during the dot-com bubble in this space. Looking at the hardware and semiconductors, those have been growing their earnings at 50% per annum. And likewise, you've had a sort of 50-odd% or a 40% return from the share price. So also no sign of absolute mania that we saw in the dot-com bubble. The only difference there is that, are you paying the right multiple at the moment? It's 50 PE for 50% growth in earnings. That's a question for portfolio managers and choosing the right price. The point here is that, one, political interference, that's a red flag in terms of the stability in terms of the system. Second point, dot-com bubble versus current. There's no sign of that extreme euphoria. If we step back, Eugene, do you mind if I have a few more minutes? Or are we good? 2 more minutes. Okay, great. This is quite a nice chart. If we step back and we have a look at the markets, a look at the S&P over the last 100 years, just to try to contextualize where we are currently. The blue shaded area is your earnings times by a certain multiple. The lower bound at 11 times multiple, the top bound at about 21 times. I spoke about earnings being a good proxy for share price returns. You can see that share price has followed earnings over time, over the 100 years. What's quite impressive there is that the returns has basically been 6.5%. So that's on price. Obviously, you get some dividends, so roughly a 9% return is kind of what you should expect from the market. Anything more, your manager's doing a fantastic job, the market at the right time, and anything less, would be disappointing. The other takeaway points here, as I spoke about when the Fed and Nixon interfered with the Fed in the 70s. I think I've got a pointer. Yeah, so you can see here during that period the markets moved sideways. There was a build-up of obviously stagflation and an inability for the markets to generate decent returns. Other notable points here is the dot-com bubble. You can see that on a trailing PE above 30, close to 40 odd, that you also subsequently had very low returns for almost a decade. So I'm just highlighting the potential dangers that are existing now in a trailing PE of 30. The market is way above the blue shaded area. So in conclusion, I'm going to skip through all of this. The main point is that even though the markets are at very stretched valuations, the very fact that you have this potential influence by Donald Trump and his administration on the Fed, there's a risk that with some outsized, at the moment the consensus is roughly 3 cuts in terms of interest rates. If the economy manages to remain semi-robust and you don't have any downgrades in earnings and any surprises on that front, we could still enter that mania phase, is what I'm saying. It's a small chance, but it's something to think about. And to not get caught up in the sense that if the market does do that and your manager's been slightly left behind, just appreciate the fact that we are in the red zone in terms of valuations from a global perspective. And that's it. Yeah, we've been managing money for the last more than a decade, and happy to show that some decent performance, and that's as a function of managing the uncertainties with some of those pointers that I pointed out earlier. Thanks, Eugene.
Mark, thank you very much. Just before we break for tea, one very quick question, more philosophical than anything else. In your balanced manner, I know your benchmark is a peer group average, but if you look at your strategic asset allocation, you've got an absolute number in mind we normally start off with. And let's assume that absolute number is normally inflation plus 4 or 5 for a typical balanced fund. Given the new inflation target of SA at 3%, how do you think about strategic asset allocation? Does that impact on how you think about it? Because, I mean, if you really think about it, let's assume they get the 3% right over the next 5 or 6 years as an average. Typically, you would have told clients, inflation plus, let's say, 5 for a balanced fund, so it's 8. If I tell a client 8 is your target for a balanced fund over the next 5 years, they're going to say...
They're going to say that you sound mad, sorry, with an 8%
Nominal return,
Nominal return.
Yeah.
Yeah, so I think the thing to appreciate is that, the markets go through many different cycles. And we just happen to be in a period of time now where you get very high real rates from cash. You're getting very high real rates from bonds. So almost with closing your eyes, you can generate a 5% real return.
Yeah.
You've got inflation-linked bonds that are trading at 5% real. You've got fixed bonds that if they reach that target, your 5% real return is going to be very easy to achieve with bonds. And then at the same time, we've heard the same sentiment coming through from the previous speakers in the local equity space. There's extremely attractive valuations that are on offer. Even if we don't maybe meet some of the growth prospects that are out there. So I think it's a fantastic time for investors, and even investors on the lower end of the spectrum. So in that balance space, reaching real returns should be very easy, actually, at this point in time. And I know that if we rewind to 2014, 2015, markets were actually very expensive. And so we had a period of 10 odd years where, well, maybe not 10 years, but you had a period of return where, advisors were actually very angry and very not happy with investors, with their managers, simply because it was so difficult to generate a real return. But I think we're in a period now where, achieving real returns is going to be quite easy. But then obviously, 5-6 years down the line, and we've already seen local bonds rally extremely hard. We've had fantastic returns, and even now that the inflation target has been lowered, there's scope for additional, even probably closer to 10% nominal. So it's very attractive. So I think let's take the wins while they're on offer now. But there will come a time where that will swing. But at the same time, we've got to be cognizant of the risks. So in that balance space, it's not all going to be plain sailing. There's going to be volatility. And, there might be periods where you need to have other assets, potentially offshore exposure, to help manage the bumps.
Yeah. Let's see how it plays out.